And some block trades coming off here. All right. Just getting everything kind of set up here as we look at the last hour of trading. I think this has been a pretty interesting day overall. So I wanted to just jump back on Mike and provide a little more commentary. What am I seeing underneath the surface here as we close out a $2.4 trillion notional roll off today? Hope everyone has had a good week and has some plans for the weekend ahead to relax. Always good to pull away from our screens, do something completely different, even if it just means learning new things. So that's what I'm all about. I really enjoy spending time over the weekend doing research, learning, figuring out new things, new strategies that I might consider implementing, doing new back testing, writing code, all that kind of fun stuff, right? All right. We do see a little bit of a basing effect here in the S&P as we approach the close. We'll take a look at the NASDAQ here in just a moment. Got the NASDAQ on screen. It's been basing similarly to the S&P here. And the Russell looking more constructive overall from the lows. And seeing some block trades going through here. We'll take a look at rates. Really a pretty good recovery in the twos from their lows earlier. We had that happen both post PPI and post University of Michigan, and then they started to rally back in, closing some of that gap that was formed earlier. Gold has had an overall constructive recovery. If we go all the way back here, you can see just how nasty it got this morning and how much of a bounce we've seen, with buyers actually pulling up that point of control by about $14. So nice little move there by the buyers in gold. And overall, that price action pretty good from trough to peak. If someone was buying here at or near those lows, or even just waiting for that reversal higher, there was some money to be made in gold. It's not a super liquid contract. You can see it's only trading about 5,000 depth. So it'd be a small position size for me if I was trading it, but nevertheless, gold looking somewhat constructive. We'll take a quick look at the euro here. I look at this as the counter of the dollar, right? It is about 70% of the US dollar index weighting, so it tends to matter quite a bit from that perspective. So we'll go back to the S&P here for a moment. Yeah, we do see Japan and the UK in recession, Germany showing some signs of similar. That is going to have some impact on global demand, without a doubt. And S&P just sort of chopping along here. We did have that really big expiry in the morning, about 1 trillion S&P options rolling off. That certainly had a bit of an impact. Most of those options expiring in the money. A lot of S&P 5,000 calls in that tranche. Now we're in the PM expiration window in this last hour. A lot of single stocks and ETFs. A lot of call heavy skew as we roll off here. You can see what's happening to SMCI. That stock has been pummeled today. A fair amount of that has to do with just how imbalanced things got. The stock has lost about a fifth of its value, but it's down to 809.35 as of 3:05 p.m. And I posted about this, and I've been posting about it and talking about it and navigating the markets on Traderade as well, that some of this single stock skew was getting so thoroughly distorted, so lopsided, that, it was kind of inevitable that at some point, if there weren't a continuation of even more robust supportive flows, that these things were going to have to roll over. And so we're seeing a little bit of that in SMCI today. Obviously, the big event next week is going to be NVIDIA earnings. We're paying very close attention there. I had someone ask me a really interesting question in a DM. They asked me, what is my preferred setup for trading in terms of hardware, software, computer, chair, desk, all that sort of stuff. I would say, it's going to vary from person to person in terms of what works best. Like, how elaborate is your trading system? How much computational resources does it require? How many screens of data benefit you? Some people, get a little more analysis paralysis with too much data. Other folks lean into having an abundance of data. It might help them, especially if their systems are automated. So I'd put that out there as a caveat that, to each their own. But you do want a computer that's capable, right? So you definitely, in my opinion, I really like AMD CPUs. There's nothing wrong with the Intel, but I lean more towards AMD. So the Ryzen 7 series seems more than capable, probably something that has 12, 16 cores, gives you every bit of multitasking capacity you might need if you're running multiple different programs. Probably having about 32 to 64 gigs of RAM isn't a bad idea. You could probably get away with 16 if you're going a bit program light. And solid state. I mean, I would not go back to spinning disk. You couldn't pay me to go back to spinning disk. So NVMe Gen 4 solid state, Samsung 990 Pros are great drives. So that would be kind of the crux of the system. And then, looking at the desk and chair and keyboard and everything, I go ergo. I'm on my computer all the time. So everything is ergonomic. My chair is Aaron Miller. I know they're expensive. I've had it for 20 years. The chair is just like it was when it was new. I've had to maybe update and tweak a few things, maybe replace a few parts along the way, but you get what you pay for in this world. Similarly, I have a Keychron Q10 keyboard. It's a mechanical ergo. And because I'm always on the computer and typing and stuff, it actually helps a lot. But the quality of that typing experience, believe it or not, makes a difference. And I have macro keys. I've assigned them for different tasks in my broker, buying, selling, being able to look at the options chain and so forth. So I just have a really kind of straightforward configuration for that. So I'd say for everyone, your trading system is going to vary. Like what is ideal for your setup? I have 1, 2, 3, 4, 5, 6 screens right in front of me, and then 2 big TVs on my left as well. And the biggest screens in front of me are 2 ultra wide 34 inches. So it is a bit of an elaborate setup, but it's because I really do use all that screen real estate and all that computing power. Like I have a 16 core AMD 5950X, 128 gigs of RAM because I'm running virtual machines and a bunch of different algos and even some LLM stuff on here, believe it or not. So I really do use all that capacity, but to each their own, right? And you could always upgrade. If you get a decent computer, not like a laptop, but a desktop, you can always upgrade. I prefer desktops, personally, when you're trading. Obviously, if you're on the move, it's going to be a different story. So let's go back into the markets here. We're going to take a look at what's going on as we wrap up the trading week here. S&P is just kind of flat. We got this large resting offer above us right at the point of control, right below the volume weighted average price intraday. If we zoom out a little bit, we can see all the options flows and positioning that are important that my SPX options visualizer is mapping out on Bookmap. In terms of trading software, by the way, I realized that was a question I didn't address. I personally, and, I'm not slighting any other software here, but I like MotiveWave. I like Bookmap. I like TradingView. I like TrendSpider. They give me most of what I need. I also really like Python because if you're a coder, there are so many libraries for Python that you can tap into that can give you so much capability without having to rebuild the wheel from scratch. And I think that's a huge, huge benefit. So I really, really do like using Python as a language for building tools, whether they're analytical tools, whether they're trading tools, whether they're backtesting programs. Python has all these libraries and a lot of open source code on GitHub that you can tap into to start to learn more and even build your own code base. So something to take into consideration. We can see price getting pulled into the warm put. That means the second most active put contract on the S&P options chain today converted to ES levels. That delta is about 16.75 for those keeping score. Which data service do I think is the best for live options data? I mean, you can go right to the source. It costs more, but CBOE is where the vast majority of options transacting happens. So they have the best data hands down. But there are going to be other services that are essentially brokering and repackaging that data that one can look at as well. Do get too much of a pull down here below the warm put, the hot put becomes a reasonable target. Put wall, probably a pretty strong area of support in the S&P 500. Below that, we do have the gamma flip level, which if we do close below it, definitely increases vol because you have more likelihood that dealers are going to be changing up their hedging patterns. Right now, we're in a positive gamma environment by our naive model, which looks at all these bought to open on both puts and calls, and often they are. But what that suggests is that in that positive gamma environment, you have dealers buying dips and selling rips. So that's a vol compressing element. On the other side of that, if you have negative gamma, you've got dealers selling into dips and buying rips, which tends to exacerbate vol, right? So it really is going to be important, the context here. But we are a ways away from that flip level, right? We're about 36 handles or so. So I don't think that's something that necessarily happens into the close, but something to look at. These are levels that are recalculated in near time throughout the trading day every minute. Over the course of this week, vol's been bid up about 10%. Of course, a chunk of that is expiration and rolling forward. So that's not necessarily a true 10% gain, but palladium up 9%, oats up 6%, lean hogs up 5%. And on the other side, natural crash, as I like to call it, down 12.72%, followed by corn down 5.77%, wheat down 5.67%, and heating oil down 5.17%. A little bit of weakness in the energy complex in parts of it, although crude, West Texas Intermediate, was bid up 2.27%. Across the heat map of the S&P 500, winners this week include Wells Fargo up 8.29%, Eli Lilly up 5.95%, Uber up 11%, Applied Materials up 8.28%, Netflix up 4.5%, and even Tesla adding to the gains here, up 3.54%. On the other side, Adobe down 12.16%, Google down 5.57%, some of that attributed to increasing potential search competition from OpenAI. Microsoft down 3.75%, Apple down 3.5%, and Amazon down just shy of 3%. But overall, there was a pretty decent bid across the heat map this week for the S&P 500. It was really the large caps that were showing more distribution outside of NVIDIA and Meta, the mega caps, I should say. And that is kind of to be expected. You know, there's such a persistent bid for those two. They've been leaders this year, and so people are continuing to kind of pile into what's working. Similar with Uber and Applied Materials, especially after earnings. Crypto, just a little bit of a pullback today. Bitcoin just shy of 52,000 at 51,817. Ethereum at 2,772.80. Now, over the course of the week, a little bit of a different story. Bitcoin was bid up 7.17% this week, and Ether leading the way up 10.07%. We are getting some central bank chatter from the Bank of England's governor, pretty late for them over there, but nevertheless saying there are reasons for caution over the downward path of inflation. Services inflation is the reason for concern. There's only modest evidence of a reversion in inflation to a level that is compatible with the inflation target. And recession is not necessarily bearing down on inflation. So UK, a bit of a struggle there, bit of a potentially stagflationary regime based on Pill's commentary. Let's take a look at the NASDAQ here while we watch paint dry with the S&P. Really nothing going on there over the last half hour. NASDAQ kind of a similar look, although we are seeing some interesting flows in the resting offers and bids that are sort of appearing and disappearing. Spoofing anyone? And then we got the Russell, which is just choppy as can be. Similar look with the NASDAQ and the S&P overall. And then this crude contract, I'm going to roll that forward. Got rates showing a little bit more signs of relief. And gold kind of continuing to defend this 2023, 2020 area as we see buyers pull up the point of control. So we'll bring it back to the paint drying simulator 2024 that we know as the S&P 500. Someone asked me to, Aaron, yeah, asked me to save SMCI. I'm sorry, my friend. Yeah, there's very little I can do there. I know you're joking around, but there's very little I can do with that one. They got way too ahead of the itself, you know. Someone asked, "Do we see S&P 5,000 today?" I would say that, you know, the folks here that are on the most active put strike certainly are interested in that level. So whether we see it or not, you know, that's a little bit more foretelling the future. Right now, this market is coiling up. So what I like to say is, you know, when we coil up like this, typically we're kind of like a coiled spring. We're building up energy for a move. This point of control and this large area of resting offer above us, I think if we push through that, we've got some pretty good room higher. We could get a pretty chunky move higher. You know, we've got gamma 3 as resistance, and then we've got this overhead area of high interest at the hot call. Either side, if we pull below that warm put, I think that hot put and that put wall are reasonable downside targets. So we'll see. Right now, we're just sort of coiling up, consolidating, preparing to potentially do something. I've been asked, can I remind us what is the liquidity differential indicator show on Bookmap? That is the order book liquidity differential between buyers and sellers. So when it's negative, there's more selling. When it's positive, there's more buying demand in the order book. And it's number of contracts. So when it gets extreme, it can be interesting. Like if you get a big pull and then suddenly the liquidity differential tool turns like 4-digit positive, then you know you're starting to see some potential real buying coming back in, imbalancing things. And if we believe the market is a two-way auction, then that suggests demand is exceeding supply and we could get a rebid. Thank you for the compliments. Appreciate it. Let's go back to the NASDAQ here. Again, I always like to call this our momentum leader. We watch the NASDAQ for clues as to how the rest of the market might take shape. So we're going to zoom in on the microstructure here. We do see a large resting offer above us. There's been a lot of interest around 17,900 as well earlier. We'll see if that still exists. Let's zoom out. Not quite as much, but we do have a decent level of interest right above us here at around 17,794. And you could see these bids just sort of appearing and disappearing, sometimes being filled, other times just probably a little bit of spoofing. Russell continues to consolidate here. Rates continue to show some degree of relief, pulling back here, but really that nice buildup here should be supportive to equities. Rates have been kind of leading the market here today. With the S&P, just like with the NASDAQ, we're going to zoom in a little bit more to the microstructure as we approach the close. That last half hour of trading tends to be pretty volatile. So, you know, it's a good time to clean up one's books as we approach the weekend. And starting to see a little bit of microstructure improvement. As I've been saying throughout the day, higher lows and higher highs are constructive. We do see that pattern here. Here's a higher low, higher high, higher low, higher high. Let's see if we can get bid back up into this key liquidity zone and push above. So we'll zoom out just a little bit. That way we can take a look at what might build above us as well if we see some more signs of offers building above and fading below on bids. Let's take a look at some of the unusual options flows here. We got some call selling and SMCI into the close. Pretty chunky amount of premium there, about $400,000 or $500,000. They're selling the 1,000 strike. On the calls on SMCI. You got some Tesla calls being sold into the close. You got some S&P puts being bought into the close. Targeting SPY 497 with about 320,000 in premium for next Friday. Probably some hedging there. BOE's governor concludes saying, we will have to wait several more months before we can be convinced that persistent inflation is gone. So a little bit of hawkish claptrap, despite their economy being in a recession. They're not pivoting towards a more dovish posture yet. And I do enjoy my tea. So if you hear clinking and pouring and all of that, that's what's going on in the background. Let's take a look back at the NASDAQ here. It's starting to build too. It's got that same sort of look as the S&P. Higher lows, higher highs, random spoofed bids below us, which is interesting. Coming and going as they please. The Russell, a little bit less constructive looking overall, but still higher lows and higher highs. And with the S&P, we've got interest at that hot call building. That level is going to be about 50-40 on SPX. Let's see what's going on out there in the world of financial news. The Trump fraud case ends with a $364 million fine and 3-year ban. California's ambitious offshore wind goal seen as unachievable, which is likely true. It's going to be very hard for them to do that given how deep those waters are. Wall Street's wagers on Fed rate cuts hit a snag. Yeah, you don't say. Maybe they were just a little bit too optimistic with 5 to 6 rate cuts being priced in going into this year when the likelihood is maybe 2 or 3 in the back half of this year should inflation slow enough. Not that there's a strong and compelling case for the Fed to cut rates in a situation where stocks are near all-time highs, housing prices is near all-time highs, financial conditions have eased more so much that now they're easier than before when the Fed had done any hiking. You've got Bitcoin being bid up to multi-year highs. You've got a tight labor force. You've got banks lending again. There's not a lot of reasons here to say, boy, we really need the Fed to come and save us. So it is interesting that that whole drumbeat for Fed cuts was as loud as it was. And, when you look at Fed funds futures, I always like to remind people we're not looking at something that's meant to predict the future. That is not the point of Fed funds futures. And I would argue it's actually much more about gauging expectations. When you look at Fed funds futures, if you look at them, in all variety of charts, what the data is representing is what a variety of parties that are hedging and speculating think may happen at that given moment, given all the data that they have. So why does that matter? Because sometimes when markets are pricing things in that aren't necessarily going to happen or are very low likelihood to happen, it can present trade opportunities on the other side of that trade. Like, for example, fading 2-year note futures into peak speculative, dovish Fed euphoria. That was a good trade. It was an easy one. Why? Because 2-year note futures are a proxy for the opinion of where Fed policy is going. And so when it became less and less realistic that the Fed was going to cut in March and then May and then June, and now we're moving out to July, we've seen that 2-year roll over for the most part. So, when you look at Fed funds futures, it kind of tells you this is where a lot of folks that have, varied opinions on the market are putting their expectations, and it's sort of like a voting machine. And when those expectations are misaligned with reality, there may be opportunity. And there was. Those are always longer term swing trades. We're looking at the NASDAQ here on screen, still kind of chopping along here like the S&P. Russell, similar look here. But overall, S&P is really starting to look a little bit more constructive than it was earlier. Again, zooming into the microstructure, higher lows, higher highs. Let's see if we make another higher high here. But overall, pretty constructive as we approach this huge wall of liquidity above us, which, as you know, these walls can act as resistance, and it may yet again. We did see more small traders kind of getting stopped out on their shorts, and that last little move higher wasn't a big change, but now we're starting to see things move the other way here, and we are starting to see some sell stops trigger. And the S&P has kind of gone back to being the paint drying simulator 2024 as we chop sideways into the close. Yeah, greetings right back to you. Thanks for tuning in. Really appreciate it. Yeah, SoftBank's an interesting case study in pump and dump, isn't it? They had such a big influence on Nasdaq stocks, and I think it was in 2018. And then you have to start wondering, okay, is that extending to ARM and some of the unusual call volumes that we had seen in that, some of these other stocks? Are they up to no good again? Well, who knows? I mean, if they are, they're probably sophisticated enough to hide that a lot better than they had previously. We do see the market early on close imbalance, about 73 million to the sell side, which is relatively immaterial. These MOC numbers generally don't have a big effect. Yeah, that's not cool. I'll be right back. All right, I am back. Let's take a look at the Nasdaq here, see if it's telling us anything different. So yeah, that constructive trend kind of breaking down a bit. Hey, thank you so much for the feedback. Really appreciate it. It's a lot of fun to do these streams, so having the positive feedback is an added bonus. I'm glad people are finding it useful. Plan to do them more often, both on our Traderade Discord and for the general public here. New York City office vacancy over 20%. It's a headline that's just passing on Bloomberg TV right now. And I think it is important to contextualize this whole commercial real estate thing. It's not all of commercial real estate and it's not everywhere. It's pockets of weakness in office buildings. New York City, San Francisco, Boston, Houston, lots of areas have weakness in their commercial real estate. It's not broadly distributed across all commercial real estate, and it's not all regions. Will it have consequences? Absolutely. Regional banks with high levels of exposure, like MTB or M&T Bank, could see some negative consequences from that. We already saw what happened to, was it New York Community Bank, which bought the ill-fated Silicon Valley Bank's assets. I think anything that touches Silicon Valley Bank is probably cursed. And getting a bit of a pull here down to the warm put in S&P. Really couldn't even get back up to that death cloud zone. I was looking for a minute like we were going to have some constructive price action here, but as we approach the close here and as we have a lot of that single stock call skew and really call exposure rolling off, we're seeing a little bit more weakness. NASDAQ's leading that way lower, actually making a new low in a series of lower highs, lower lows. So the microstructure is now inverted and become not constructive. It's favoring sellers. And the Russell is just falling off a cliff there. See you later, Russell. And then rates still getting a decent bid. Gold still seeing a decent bid here. And the euro still seeing a decent bid overall. So this is really a story of equities and OPEX. And if you folks are enjoying this stream, feel free to share it with others. I'll be on here for about another 20 minutes. I'm going to stop when the market closes. And then I'll be back on Monday. And I'll be doing a Bookmap stream on their YouTube, my YouTube, Twitter, and elsewhere on Tuesday at 9 a.m. So be sure to tune in for that. I'll be talking more about how I use Bookmap, some of the things I look at over the longer time horizon. We're getting drawn down right to the second most actively transacted put strike here. We see some liquidity building below us. So it's starting to look a little bit more deleterious. The microstructure showing a downtrend. And that's pull is intensifying here. NASDAQ leading the way lower, almost a little bit of like micro free fall here. It's kind of an intense little sell here into the close. We're not really even in the most volatile part of the day, which is the last 10 minutes, but the last 20 definitely amplifies that. You got folks that have to transact before the weekend. Indeed, they are. You also see some resting bid building up right here by that most active put, making it a more important level to watch as we get into the close. And my apologies, I misspoke. I won't be back on Monday because that will be Washington's birthday. Kind of awesome to have a 3-day weekend, all things considered. So, not going to complain about that one. Time has been flying by so fast, I lost track of some of the market holidays. Still seeing this continued pull here into the close. Pretty decent amount of transacting happening here on the sell side as well. And NASDAQ, similar look here, just lower highs, lower lows. That microstructure inverting to a downtrend. And Russell, exact same look. Rates are still supportive of equities here, but try telling the equity market it has other ideas. We have seen price pull below the second most actively transacted put contract for the S&P. We do see some liquidity building below us and lightening up above us. and making just a new low here in S&P. NASDAQ looking a little bit more stable just right here. Nope, never mind. NASDAQ now making a new low as well, following the S&P lower. Russell having a similar look. Gold's still pretty resilient, all things considered. And these lows are being made with reasonable volume. There is some conviction behind the selling here. So seeing the most actively traded put strike as a downside area, a potential support, and then finally that put wall. Those are the two levels I'd be watching here on ES and SPX. Someone asked me earlier, could we see 5,000 today? Seems pretty likely now. And I mean on SPX, just to be clear. The delta between SPX and ES is a positive delta of 16.75 based on the overnight calculation. I think next week is going to be very interesting. This is where seasonality could play a bit of a role, but also that window of weakness where there's a lack of those supportive flows for the market. We really entered that window yesterday, but it becomes a little bit more realized in the week ahead, which is seasonally a pretty weak time of year. It's the worst time of year in terms of a back half of a month for the S&P going back to 1928. Hedges remain cheap. 6-month at the money SPX puts are incredibly attractive. So if one's not looking to realize gains, there are other options out there for insurance, as it were. And by the way, I hear a lot of people, kind of talking about bears as if they're always short. And I find this very interesting, having been in the world of trading for 19 years and investing for 18 years, knowing a lot of fund managers, including long short funds. I've never met a fund manager that was net short. I've never met a long-term professional trader that was net short across all their equity or across their entire portfolio. Never. Like, it's very rare that kind of thing happens, because maybe you could be net short in your trading portfolio, but that's different because you still got your retirement, you got your taxable account, you've got other areas that offset it, right? We're all de facto long the market. And so, even if one is expressing a bearish view, it's very likely they're still net long. They just might be less net long. They might have reduced their upside exposure, or they might have added some hedges. So I always found that kind of commentary very interesting. It's not realistic. People don't survive staying net short. The markets generally over long periods of time go higher. So it has to be very tactical, and it's generally part of a net long exposure as an insurance mechanism. New lows in the S&P here as we approach the close, getting closer to that hot put strike. We talked about watching it. It is acting a bit like a magnet with resting bids growing as we approach it. NASDAQ, similar look here. Still getting that pull here on reasonable volume, more stops being triggered. And Russell actually getting a little bit of a bounce here, but it had a nice roll down from being rejected at that convergence of the point of control and VWAP. Got about 11 minutes left in the trading day. The last 10 tend to be more volatile. Not a bad time to consider what one is going to do with their books into the close here. I'm sure some folks are feeling a little less comfortable being leveraged long into the weekend. What a disaster IEP has been, huh? My buddy Boog mentioned the volume on SMCI, which is down, losing about a fifth of its value today, down 20% to 803.95. Volume is about 5 times normal. On SMCI, volume's about 5 times normal, 32 million shares trading today. Average volume about 6.8 million. So that is pretty incredible distributive pressure on that stock. The call skew had gotten so thoroughly blown out of proportion that it was so just thoroughly slanted towards calls. It was showing it was a speculative bubble that was going into euphoria. Parabolic moves, no matter what it is, rarely end well. And that is the lesson on this sort of environment. You know, you got to be real careful. Yeah, they can keep going up. They can go up to irrationally high levels. But they can also pop, and they can pop violently and quickly and cause a lot of pain. So when trading bubbles, you either don't trade them at all or you get in early and you get out early. That is my own 2 cents, having traded through bubbles before. You really, you have to be able to identify them. You have to be able to figure out what the narrative is, what the key beneficiaries are. We're the ones that are a little bit less realistic, and we're the ones that are more, there's a true story happening in the AI bubble, as it were. There's picks and shovel sellers like Nvidia, SMCI, Microsoft, Palantir. They had these huge bids. It's real, but it's getting ahead of itself, right? You're pulling forward years of future returns into the present. Got about 9 minutes left here till the close. Oh boy, degen plays that are memorable. I have a lot of those. So one of them that I absolutely killed it on was OGI. I want to say this was late 2021. Actually, you know what? I think it was spring of 2021. I'm looking back at the charts here. But basically, this was a play where I got pretty aggressively into it at about $2, maybe 150, around there. And then I started exiting after hours at about $6, $7. And this all played out in the course of maybe like 6 or 8 weeks. And it was all just a cannabis bubble, as it often is. And I was playing this with shares, and then I had some call exposure I got out of the next day, but it was mostly shares. And this thing absolutely surged and it crashed, as often is the case with these garbage fires that we call cannabis stocks. So that was probably one of my more memorable degen plays. Palantir IPO, just getting irresponsibly long and then selling into the euphoria, taking some of my position off. I still have a big Palantir position. I have been building into it when it got a little too cheap, but I saw signs that management were turning things around. But that Palantir speculative play was a lot of fun, right? Just basically from $9 to what, $42 or so. I got a good chunk of that. I got about 950 to 40 on that one. And that was just pure degen. I mean, yes, there was a narrative, but it got way ahead of itself. One of my friends said, it looks like they're being priced into, being able to turn water into wine. And it was around that moment I realized, yeah, it's probably time to let go of like a good chunk of this irresponsibly large position. Um, I've had a lot of degen trades that were kind of silly, but ended up working out because luck. And since I had been so lucky during some of those easier times, I got a little bit more conservative with how I trade those plays. Nowadays, I'd rather trade those plays with either calls or call spreads, right? To limit my downside risk. If I'm right, I can be really right. Like on Zim, I had some calls that were up like 5,000% when I cashed them out. That was insane, but I didn't put a large amount of capital into it because, you get that upside asymmetry with calls, so you don't need to. And I think that's what it comes down to is just, when you're taking these really, really speculative plays, there's no reason to get too aggressive. Getting a little bit of a rebid here off the hot put level. We talked about that potentially being support. We got liquidity building below here a little bit, but this may be kind of about it. We'll see. We've got about 5 minutes left in the trading day. This was the level I was looking for to see a bounce. We can see some liquidity continuing to build below us. We are seeing a bounce off that hot put strike. We also see some liquidity building above us here. That may be where price is heading towards. Last 5 minutes on OPEX Friday, got to be a little hectic. But we got exactly to that point that we were talking about, that hot put. So not a terrible place to take off short positions if one was so inclined to be fading that death cloud rejection, which happened repeatedly today, by the way. Kind of interesting. Either way, no more interest in really trading this thing today. It gave us some decent opportunities. Most of those opportunities were qualified by the convergence between resting and active liquidity levels and where people were interested in transacting their options. So I'm really kind of building systems to take advantage of this. That's what you see on screen. It's the SPX options visualizer for Bookmap. We have that available on the Bookmap, I can speak, Marketplace. And it's also streaming on the Traderade Discord with a number of different tools we offer our members as well. So, I'm really interested in kind of the convergence between technology and finance. And one of the ways I express that is developing software. It's a lot of fun. I'll be doing more of it this weekend. If you're interested in what we do at Traderade, check us out at traderade.com. You can get 20% off with the code MAYHEM20 on your first month or quarter. You can also check out Bookmap at traderade.com/bookmap. Scroll down to the specials, get up to 40% off. And the SPX visualizer that you see on screen, the options visualizer, it's now live. You can go to traderade.com/SPX to learn more. So I hope everyone enjoyed the stream. Got about 2 minutes left in the trading day. After that, I am going to hop off and start my holiday weekend. And I'm wishing everyone well. I hope you had a good trading week. If you didn't, don't beat yourself up too hard. Always take good care of yourself, no matter how well or how poorly you're doing in the markets. It is a really, really important part of being a trader that has sustainability, that has staying power, right? If you get too greedy or if you get too jubilant because you did well, you might start taking silly risks and blow yourself up. If you get too beaten down because the market's not going your way, you might start making poor decisions because of that. Revenge trading, avoiding trading entirely. You got to kind of figure out your balance. There's a very, very, very important element of psychology in trading. It's not just charts and clicking buttons. If you want to learn more about that, check out my YouTube. The link to my YouTube is pinned on my Twitter. I've got a whole video about the psychology of trading. I'll be talking about that more as well. It's such an important element of success. It really is. Got about a minute left in the trading day. That hot put became the most active contract on the S&P. You could see that into the close. That interest built there as we talked about that level becoming a magnet, indeed it was. Price hit there not once, but twice. And then we got a bit of a bounce there because we did talk about that potentially being a bit of a level of support. So it was. That closing bell getting ready to ring. So, folks, if you have positions open and you're a day trader, you got to look at squaring up those books. Don't wait for the aftermarket where it gets a lot less liquid. That becomes more risky, more slippage. There's that huge heat map liquidity build for the final minute of trading. Boom, you can see all those bids and offers just appear out of nowhere. Look at that contrast right here. Yeah, I appreciate all of you as well. Thank you again for tuning in. Got about 30 seconds left. This is where you see that huge heat map buildup. Just it gets like real thick, and then the market closes. We go into that after hours session where it's less liquid. So wishing everyone a wonderful weekend ahead. Check out my work at Traderade. Check out some of the software I'm building and other work I'm doing here on Twitter, on YouTube, and elsewhere. Definitely check out our Traderade Discord. The community there is the best out there in the trading world. I'll talk to y'all soon.